Welcome back to another episode of Gimme Some Truth. Clint and I are in the booth. It is February 2026. That's important to state because our market outlook is printed, published out for everybody to take a look at, and we are going to tackle the last article of the market outlook, 5 catalysts that we're watching in 2026.
That's right. I mean, when the market outlook gets written, the whole concept of it happens in the second half of the year, and then we finish writing the articles really in December.
Yeah.
And, in this market now, things can change on a dime. Narrative can change over weeks now. It does seem. I mean, you and I have been doing that. What are you on? What year are you on? And
it was either 20 or 21 years.
2021. I'm like 25 or 26, something like that. And the market moves at such a pace right now.
Yeah.
It's pretty shocking,
Yeah.
Where all of a sudden that something blows up and it changes and the narrative machine is strong, and 1 week it's one way and 1 week it's the other way. And so it's been an interesting 2026 so far. No question about that.
Yeah. And I think a lot of that, and this is the fifth point we'll talk about, which is the topic of the flavor of the day, flavor of the week, flavor of the month, AI, right, and how that's moving things around. We're also going to touch on 4 other topics. Domestic valuations, kind of they feel stretched, they felt stretched for a while. Kind of what does that look like? Reemergence of international markets, really interesting there. That we've been kind of waiting for that to start, and it has in a big way. And then a couple other ones that are a little bit more economic based, which is impact on the next Fed chair, and then is inflation under control?
The new normal?
Is it the new normal? Is it under control? Is it not? Is it So let's start with the first one, which is this is a topic we've been talking about for a while. But first of all, are domestic valuations stretched, and if so, what does that mean for 2026?
I mean, the answer to that is just absolutely.
It has to be yes, right? I mean, it has to be yes.
Yes, and so I talked about this in many meetings with clients, and I just say, hey, look, for us to get significantly higher prices from this point, we have to have record earnings. And you know what? It might happen.
Mm-hmm.
It's not to say that this isn't going to continue and that everyone should sell out equities or cycle back into different types of equities. It's possible this could continue, but we do have to see record earnings, and there's no question about that. And so, right. And you think about companies too and how they're going to manage their balance sheets, and you see it already. You're not seeing an enormous amount of hiring, and
right.
You're seeing expenses being cut with these companies as well. So you're going to see these companies, because they're spending so much money on outside projects, they're cutting expenses in other areas, including personnel.
Yeah, it's obvious. It's an obvious statement to say that everybody watches earnings reports closely, because that, regardless of the year or the what's going on, people watch them closely. But I think there's almost an extra emphasis in 2026 because, as you said, to be able to continue to grow and push valuations higher, which they might, right? The earnings need to back that up, and so that'll be very, very telling in 2026.
Well, you can see too, there have been a couple of instances.
Yes,
Microsoft one, right. Amazon another, where they missed their number
and they got punished.
They get punished really bad when you miss your numbers right now.
Yeah.
Or we have more CapEx spending than anticipated, and all of a sudden the market comes down hard on that stock. So we are seeing more punishing things when we see an earnings miss.
Yeah, I think that's a good point to call out. And then we'll move on to the foreign investments. But it's the market is punishing individual companies based on misses much harder than it normally would, and that's a direct correlation to the stretch valuations for sure.
Exactly.
Foreign investments. We've been waiting a while. I
feel like we've said for 15 years that, relative to U.S. stocks, they provide a compelling story and good diversification. And boy, that just has not come to fruition for a long time. And finally, the sun started shining on international investments last year. There's a number of different reasons for that. And then, it's persisted through this year. And it's not just, it's developed markets, it's emerging markets, it's frontier markets, it's all sorts of markets that are international.
And sectors
as well.
Right.
I think, there's a twofold sort of thing. I mean, number one, obviously the weak dollar is contributing to that. So there's definitely a dollar. I don't know. Some people are calling it de-dollarization. I think that's overdoing it. But we are seeing that the dollar is weakening for a number of different reasons, and we haven't seen this in a while, but it's been a pretty significant dollar weakness that we've seen. So
do we think this persists in the international markets?
I think that we are continuing to see a rotation outside of U.S. stocks. I think that will persist. Whether or not currency is really tough to call. And the Trump administration has said, we want a weak dollar. And then last week, they were talking about stronger dollars, and the Fed chair with potential quantitative tightening. And we're going to do a podcast just on Kevin Warsh, just in general. But I think things are going to get a little tighter there in some parts of the market, and interest rates fall in others. I actually think the dollar probably, this is a little contrarian, but I think the dollar probably strengthens up a little bit by the end of 2026. But that's a prediction that I'll make. Some of the other guys might have a wildly different prediction than I have.
Yeah. It's a good segue into the Fed, right? In terms of just the impact of the fact that we'll get a new Fed chair in 2026. We know who that is now. That's not fair to say. We know who has been picked. That this person needs to be confirmed, which will provide some pretty good political theater, if you will, in the spring.
Well, we know it's probably going to be somebody named Kevin.
Right.
Because there were two Kevin candidates,
right,
and Warsh being the one that won the day. So we'll see if that is the situation. I would not call him the most controversial pick.
Correct.
You know, so I do believe that the likelihood of him getting confirmed is fairly high. You know, he used to be a Fed governor himself. You know, he's been in think tanks before. So he's pretty well respected in the industry as far as what it is. The market kind of, they didn't react too much to it. I would say a minor reaction to it. I would say it more in the metals markets than, you know, and in crypto, rather than just having a stock market impact.
Well, I think the interesting thing about this topic in general is the undercard bout might be even more interesting than the feature. The undercard being, does Powell accept his position still, you know, within the Fed, or does he exit? To me, that's more compelling in a way than the actual Fed chair, because that has kind of a domino effect. If Powell fully retires and is no longer in the Fed, then that opens up another seat that needs to be filled. If that isn't the case, and he accepts his position kind of back with the group of 12, then that position isn't available, and you know, then that has impact as well. So to me, there's a lot of intrigue in the undercard bout.
Well, not only that, and I would like to see the poly market in that one, but I would also like to see another poly market is when the Fed chair actually sits.
Sure. Yes.
There's an impending investigation into Powell in the use of renovation dollars. Whether or not that sticks around, but they have said that the new Fed chair will not be sat until that is rectified.
Yep.
So I don't know. Maybe we'll see a suit get dropped in here, and then that paves the way, or it gets all gummed up, and we don't see a Fed chair sit for a long time.
All right, let's dovetail that into inflation. So what are our thoughts on inflation? The kind of segment within the market outlook is, you know, is 3% kind of the true target now, even though the Fed still says it wants 2.5%?
It's a good question. I don't think so. I think the Fed is willing to live with a little bit more inflation in a high growth environment.
But ultimately still wants 2.5%.
I think, well, I mean, they always wanted 2, but I don't know if 2 is reasonable. I would almost argue that, you know, 2.5 might be our new normal now.
Sure.
But, you know, I do think that we're going to see inflation above the 2% level, but I don't think we're going to run away with inflation. I think there's a lot of deflationary things. I think AI is very deflationary.
Yeah.
So if we talk about that, I actually think that there's a greater likelihood that we hit 2 rather than we run away with it in the next 5-6 years, just because I do think that AI is going to be, it has a very compelling deflationary story there. So I think that we're going to start to see that back into 2s. Now, you know, the article that was written. There's some differing viewpoints in that. You should read the article. It's a great article. But overall, I would say for me, I'm looking at inflation's been coming down for a long time, actually.
Yeah, I think that's an interesting one, and it's a good point. Back to the market outlook, there's differing views in the firm in terms of inflation, not completely opposing and headbutting differences, but differences in terms of kind of how people view inflation within the firm. So we'll kind of see how that all plays out. But moving to AI, the fifth point in the article, I think 2025 can be defined as the year that AI was kind of built, right? Is 2026 the year that AI gets implemented? I guess is kind of how I would frame it.
So I would frame it in a similar way that what you're saying. I'd frame it in 2025 is the year of the LLMs.
Sure.
Right?
Yep.
So kind of how we were all introduced to it.
Yep.
We use it as a search engine now.
Mm-hmm.
And so, okay, I'm going to go and I'm going to ChatGPT this thing or
Yes,
whatever. And then we burn way more trees doing a search on ChatGPT than we do or on Gemini than we do just doing a regular Google search.
Right.
We're, burning the forests. Now this year, 2026 already looks like this is the year that we actually start to get a peek at what agentic AI looks like. And to me, that's really exciting because this is far, far beyond a search engine. And we're seeing this because it's already broken the market once.
Yep.
And we might see it break the market a few more times as we go through this whole AI trade.
Yeah, I think what's interesting about your point is that it seems like the average person, right, is using it more as kind of a search engine and almost like a Google alternative, if you will, right? That's not how businesses are using it, especially not how big businesses are using it. It's not why job losses are happening in bigger. They're using it in a much, much different way. Obvious because they're a business and not an individual, but yet there's a very clear bifurcation in terms of how the average person is using it versus how the average big business is using it.
Yeah, let me take a moment to just talk about what is the du jour moment here. There was something that was released that was called Claudebot, and it wasn't actually released by Anthropic, who does Claude. It was kind of a plugin that you do, if you will, or kind of an app that you kind of sidebar onto, utilizing Claude to run systems. And so what people did was they loaded their whole entire life onto this thing, their Google Calendar. They put all their APIs into this. Now, you should not do that at home, by the way, if you care about security. But people are running these into different machines. Some people are running them just out in the cloud, having their data everywhere. But the point of this is you could go in and start to have these agents work interdependently and then codependently with one another on different tasks. And it could read emails across organizations, and you could really find out about what is going on inside of an organization and build things. It's automated emails, automated calendar events, automated just kind of search and construction, automated code, all kinds of different things that can be constructed. And this is opening up all new avenues and doors. And so what happened in the market is that we had a significant sell-off in software as a service related companies. So if you think about like a Salesforce, things like that really, really depend on software at the core, because the narrative then changed to these Claude bots and everything. They're going to write their own code.
Sure.
And so that kind of broke the market, had a huge sell.
Yeah, it's not almost like as you said, a lot of people use it as a search engine, so it almost becomes like a path to an end, right? My question is X, and then it provides the answer Y, right? Companies are now using it to say, like, not only they're not trying to get to Y, they're trying to have the systems kind of write additional code beyond the code that they're in, and it becomes this compounding effect, and this the magnitude of which is really almost hard to get your head around in terms of what it could mean for companies. And they frankly probably don't even understand the impact of what it could have today, which is why I think 2026 and kind of year of implementation is probably accurate unless, something else breaks.
Yeah, there's one podcast I listened to, and they were talking about how they set this up on a machine, and they were setting up a podcast. So they actually set up all the agents to go out and identify topics, and then go reach out to the CEOs of those companies, basically set up an own CRM system itself, reach out, do all automated emails, do all automated scheduling, do all automated show notes, go back and forth with interface with the CEO, and then show up in the podcast,
Sure.
and then create an entire marketing plan afterwards about how to do all this and to get all kinds of subscribers. Like, that is all done by all these agents, not done by any human along the whole process. So if you can think about how many jobs that is, so first of all, a little frightening from a job loss perspective, but also from a cost perspective. When I talk about AI being deflationary, this is what I mean. I mean that we're having a significant situation where all this cost could be sucked out of all of that. And if it wrote all of its own code, do you need software? So that's where I think that sell-off came from.
Yeah, and I think that, like most things that are kind of societal changing things, right? Momental changing things. It's not all good, right? It's not 10 good and 0 bad, right? There is going to be some bad, i.e. job losses, i.e. some deflationary, which could even become bad in a way, right? If it pushes too far in that direction. So what we're saying is that we're so early on in this that we should anticipate more volatility and more bad weeks, which won't necessarily lead to bad months in the market, but we could have some very bad weeks as something gets developed or something gets released or something happens. So in 2026, it just kind of be aware of the fact that could become much more prevalent within the markets for sure.
Yeah, we had a couple of those in 2025 to pull from. We had the big, all the tariff announcements, which are kind of an externality. And then we had, when DeepSeek released their model, and then everybody goes, well, oh boy, that's like an open source model. Is that going to break all of the AI here in the US? And then we had a big sell-off in markets there because, do we actually need to spend all this money? What's going on? Chip makers sold off, so there could be some of those moments along the way this year where if we see significant discoveries or things that are released and they've just become really big, really fast, it could change valuations significantly.
Yeah.
We're going to have a big IPO year too. I mean, that's going to be fun to watch. But the last time we had a whole ton of IPOs in the market usually doesn't signal greatness. We had crypto, a whole bunch of crypto IPOs. And prior to that, we had a whole bunch of .com IPOs. Now we're talking about a significant amount of AI IPOs. So it is not without concern that, kind of when you hit those sorts of things and all these companies start IPOing, is that the peak? So we're a little concerned about that right now. And that's why you need to diversify, which is a lot about what we talk about in the guide too.
Yeah, and I think that's kind of the path forward for us in disseminating information out to clients is to unpack some of these articles further that we've written and do podcasts on them so that we can get into some of the nuance and really do it in a more conversational way, which I think people are going to find valuable. So this is kind of kicking that off. And so stay tuned to our sites for more information and more podcasts on the articles and just more in-depth thoughts and conversation about it. As you can disseminate from this conversation, 2026 is going to be a very interesting year. So thanks so much for tuning in to another episode of Gimme Some Truth, and we will look forward to talking to you soon.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.